Hello, everyone. Welcome to our Insights into Investment Firm Compensation webinar with J.Thelander Consulting. We'll just give a couple minutes to wait for more folks to trickle in, and then we'll begin. Thank you. So we're going to kick off. We're going to kick off now. So everybody, welcome that tuned in, and thank you for joining us today for our Insights into Investment Firm Compensation webinar with J.Thelander Consulting. My name is Max Navas. I'm a venture capital research analyst here at PitchBook, and I'm joined today by Jody Thelander, founder and CEO of J.Thelander Consulting, as well as Jim Jensen, partner at the Palo Alto offices of Wilson Sonsini, Goodrich, and Rosati. As we start off, I just want to mention that today's webinar will be recorded, and a link to the webinar will be sent to all registrants via email within the next day or two. Also, please remember, if you have any questions, to add them to the Q&A feature in the Zoom field throughout today's webinar. We'll answer as many questions as we can following our presentation. If you're not familiar with PitchBook, we're the leading resource for comprehensive data, research, and insights spanning the global capital markets, including PE, VC, M&A, and emerging technology spaces. You can learn more about our platform and new features at pitchbook.com. So now let's begin today's webinar presentation. Again, please remember, if you have any questions, add them to the Q&A feature in the Zoom field throughout today's webinar. We'll kick off by taking a look at the US VC deal activity by year. Through Q3 of this year, there was $194.9 billion invested in an estimated 11,871 deals. This year's deal activity is significantly lower than 2021, when the cost of capital was low and there were a larger number of investors competing for deals. The economic downturn starting in March of this year, coupled with rising interest rates and LP overallocation of this asset class, largely contributed to the slowdown in deal activity. As we drill down into the quarterly deal activity, you'll notice that Q3 came in pretty low. Q3 saw $43 billion in deal value, setting a 9-quarter low. The first 2 quarters of the year had higher deal value and counts due to the fact that some of those startups may have started engaging with investors and fundraising last year prior to the downturn. Notably, capital investments in late-stage startups accounted for 57.8% of the quarter's deal value, considerably lower than the prior 9-quarter average of 67%. This reinforces the notion that there's been some investor pullback from the late stage. And again, PitchBook defines the late stage as companies raising Series C rounds or later. Building on the narrative of investor pullback from the late stage, this chart looks at late stage deal value dispersion here in the US. Through Q3, the late stage median deal size was 11.5 million, a decline of 20.6% compared to the 2021 full year figure. Additionally, the late stage median pre-money valuation fell 8.2% from the prior year's values to 90 million. The late stage has been more impacted than its early stage counterparts because of depressed public market and exit conditions. Additionally, the last couple years praised the startup mentalities of growth at all costs, and presently investors are looking for more capital efficiencies and clear paths to profitability. The prior mentality caused significant startup valuation and headcount bloat, which we started to see the effects of with GPs marking down their portfolios and headcount reductions at some of the largest startups. The 2022 year-to-date figures still look somewhat high compared to that of 2020 and prior years because of the strong couple quarters we saw this year. And so through the end of the year, we may see those values come down a little bit further. Moving on to USVC exit activity, through Q3 of this year, $63.4 billion in exit value was generated across an estimated 906 exit events. You'll notice that this year's exit value is well behind the last couple of years. Some of the largest news related to exits came in the form of Adobe announcing their acquisition of Figma, a collaborative web application for interface design, for $20 billion. Their deal is expected to close in 2023, which is why it's not included in the blue bar here on the chart. And to further understand this drop-off in exit value we saw between last year and the current year, we can examine the USVC exit activity by type. And this shows that the huge drop-off is the result of fewer public listings. Through Q3 of this year, just $29.9 billion in exit value was generated from public listings, a drastic decline from prior year's activity, especially 2021, when public markets were at all-time highs. We expect this year's IPO activity to set a 6-year low as a result. And traditionally, exits through acquisitions are the most common type of exit in venture capital, but most of the exit value is actually generated via public listings. In recent years, roughly 13 to 24% of the total annual exit value was generated from acquisitions. However, this year, starkly contrasting the past couple of years, nearly half of the exit value has been from acquisitions, furthering the notion of the frozen path to liquidity via public markets. Switching gears to USVC fundraising activity, through Q3 of this year, $150.9 billion has been committed to 593 funds. This year has already set a record high for deal value. And notably, we've seen 35 funds close more than $1 billion in commitments. And despite harsher fundraising environments for emerging managers, we've seen 100 first-time funds close through Q3 of this year. Despite the record levels of capital raised this year, the fundraising landscape has significantly changed from the prior few years. This year, capital is concentrating in larger funds led by experienced managers. Of the $150.9 billion raised through Q3 of this year, $111.8 billion, or 74.1% of the capital, went into funds with more than $500 million in commitments. Additionally, 79.1% of the capital raised went to experienced managers, suggesting that investors are less willing to take gambles on new managers without historical track records or go through the costly exercise of performing due diligence on new firms. And switching gears once again, we'll now take a look at the US PE market. So looking at the US PE landscape, starting with deal flow, through Q3 of this year, we estimated $818.22 billion in deal value across 6,530 deals. This is a significant drop from 2021 when quantitative, monetary, and fiscal easing were at play bolstering deal activity. Following the economic downturn in March of this year, we saw the Fed increase interest rates 3 full percentage points in just 6 months. Rising interest rates have hurt the LBO machine, which traditionally operated with a 70-30 model, 70% debt, 30% equity. The current environment has required firms to take as much as a 50% equity component or more in order to keep costs in check. 2020's deal flow is more on pace with the old normal seen in the years 2017 through 2019. And as we look at USP exit activity, this year we've seen a year-over-year as well as a quarter-over-quarter slowdown through Q3. The frozen IPO markets have stymied exit activity compared to prior years. And in the last 2 years, public listings have accounted for roughly 1/3 of the annual exit value. This year's listings have contributed a mere 1.6% of the total exit value for investors. Sales to corporates and other sponsors have remained broadly in line with historic levels due to dry powder remaining high and prices running low. That being said, more PE firms are holding off on selling in this harsh environment, creating an unsustainable gap between the buy and sell sides that we may see, become more distinct in the coming quarters and year. And lastly, we'll take a quick look at PE fundraising this year. So through Q3 of this year, $258.8 billion was raised across 296 funds. PE fundraising activity has followed a similar trend to VC, with capital concentrating in mega funds and experienced managers. This year, the top 35 funds raised 76% of all the fundraising, compared to only 40% of the total fundraising they raised last year. Big firms are like a port in the storm. LPs may prioritize long-standing relationships with experienced VPs that have the ability to diversify investments towards secondaries, real estate, real assets, credit, or infrastructure when the PE and VC outlooks are not as promising. Now that about wraps up my update on the VC and PE landscapes. I'm excited to pass the remainder of today's webinar off to Jody and Jim. Again, if you have any questions, please add them to the Q&A feature in the Zoom field throughout today's webinar. Thank you so much.
Great. Well, thank you, Max. I'm going to take it from here. Jody Thelander, founder and CEO of J.Thelander Consulting, and my trusted colleague, Jim Jensen over at Wilson Sonsini. And Max, thank you so much. Listen, we've had a long-standing relationship with PitchBook. We're going into it's almost 10 years now, where, as you can see, PitchBook does an amazing job of showing what's going on, anything deal related, who got funded, how much they raised, all the information about the investment firms and the markets. And the one area where they don't cover is how much people got paid in compensation. And that is where the Thelander PitchBook collaboration comes in. So, and Jim and Wilson have been great because they provided us content for our questions. And I'm going to jump in here because I know everyone likes to see the data. We've got some handlers on the ground who are following the chat and keeping us abreast of if you had questions or you'd like us to navigate in a different direction. So please make sure to, if you want to see something more or have other questions related to what we've shown, please go ahead and make sure to keep us moving in your direction. Okay, so just as an aside, all PitchBook subscribers have complimentary access to a subset of the results from the Thelander PitchBook Investment Firm Compensation Survey and the Private Company Compensation Survey. And Max, I saw, it's so intertwined, right? Because you're talking about exits and the private companies and the portfolio companies. So we cover both at Thelander in terms of comp data. And so we left Morgan's name here, Morgan at J.Thelander. You can reach out to her directly or go right to your account manager at PitchBook, and we will get you set to go with that. And all the information that you're seeing here today is coming from the Thelander platform. And this is presented, it's all accessible to you as well through a subscription. And again, if you have any questions regarding this or how this might relate to you, please let us know. So the investment firm survey is now open all year round. So right now we have actively about 1,700 investment firms across the globe that participate in this co-branded Thelander PitchBook survey. And it covers both compensation, salary increase, and bonuses. And then the other surveys to round this all out for the private markets is that we cover the portfolio company compensation as well. So it makes a lot of sense to us, and I'm sure it does to you if you're on the investment side or on boards, and to know what your portfolio company compensation should be, in addition to understanding the levers that are relevant to the actual investment firm. So Max shared a little bit about venture and private equity. You can see that's over half of the data and the firms that we survey. And then people also self-identify corporate venture, investment bank, family offices. And there are some nuances in terms of the levers of compensation. The other big piece of this, and Jim, I'd love for you to jump in here as well. I mean, Max talked a lot about the different asset classes, and it is a very it is a very important part of how we look at compensation. It's clearly a very important part of where the emerging funds versus us now having 7 billion plus of assets under management as an actual bucket. This is something that's taken, several years. We used to just have 2 billion plus, and you can see that these later stage funds, or these bigger funds, these mega funds, have really continued to increase. So Jim, maybe you could just share with us from the legalese side what happens emerging funds that are growing, what you're seeing, the different complexities of the compensation structures.
Yeah, the compensation between the two firms, the two types of firms, is very different, because with the larger firms, with the management fees being much larger in the dollar amount, even though the teams are much bigger, the cash compensation is a much higher number. And so you'll see, if you look at compensation for venture overall, if you're to compare it across like all classes of firms into one statistic, it doesn't mean that much, because it doesn't reflect actual compensation. If you look at the cash compensation of somebody from a large firm versus a small firm, it's very different. And so with the smaller emerging managers, the compensation packages skew more towards percentage of carry, carry compensation, et cetera, because that's more of the upside. Now, I also think it's easier to get a multiple on a smaller fund than a large fund that has 7 billion of assets under management, or a collection of group of funds. So I think that you can make the carry numbers work more under that structure. But that's where we see the difference, is it really is in that cash compensation number and the percentage of the carry that you get that varies between these small funds and larger funds. And I think you'll see that in Jody's stats.
Yeah, let's go and move on. So we also asked the question, I think this is just by way of context, that you see how thorough the questions that we ask, and then also we can, for when we do our consulting for the actual venture firms, or the private equity firms, or the corporate venture firms who are looking to further understand their compensation and see if they're competitive. We do use some of these other custom reports on how many funds are currently being managed. And you can see, we also look at this by total AUM, and that does impact compensation. The primary location of your firm, I think more and more, this is just to give you context, that of what we survey, about 84% are within the United States. And then within the United States, we cover also the whole country. And that's changed more and more. This was the question of what is the primary location of your firm? And we definitely are still seeing that people are not returning fully to the office, and that there is quite a bit of working from home. And we do not see that the location of the firm, or where you're located, is impacting compensation at all. If anything, now it really highlights the fact that it is not geographically located. It used to be very centralized in the Bay Area, Silicon Valley, and that's really not the case anymore. The location within Europe, you can see mainly Western Europe. We just show you this by way of context, so you appreciate that the data covers the globe, and that really the best way to look at data is by the assets under management. This I find very interesting. This list keeps growing and growing and growing. This is the list of investment firm and the corporate venture positions. And I'm sure, Jim, you can speak to this too, that, now in venture firms, there's quite a bit, in private equity firms, there's quite a bit of expansive participation with the portfolio companies. So there are jobs now like business development and talent and other roles, marketing and communications, inside of the very investment firms that are parlaying those resources, like the corporates always did, to work on behalf of the portfolio companies. I don't know, Jim, do you have commentary on this? I'm not sure how involved you are in seeing those jobs, or doing, the agreements or the fund structures.
Yeah, I'm not actively involved in that. I mean, certainly part of the pitch of the larger firms now is that they're going to provide a suite of services to portfolio companies beyond, just the investment. How much that actually happens, I think, is debatable, but certainly it's not something I directly get involved in.
We see it on the consulting side with both the late stage funds, like the larger funds. The mega funds definitely have taken a page out of the corporate PitchBook, corporate playbook, not PitchBook, corporate playbook, and that they have, are counting on the business development and having a whole suite of resources that are leverageable to the portfolio companies. And also the emerging funds that are starting out are making sure that they're very active, not just giving money to their portfolio companies investing, but they're actively involved involved in other ways. So those jobs are competitive because they're you're grabbing people from both public companies, from private companies, from all aspects. So oftentimes when we're looking at a finance or operations or business development person, obviously they don't just have to have venture experience. Okay, this is a preview. We are running right now the salary increase and bonus survey. We don't typically run this until the beginning of the year historically, and we are running this now because it's part of the value proposition of Thelander that we've been able to move these things earlier because it's sort of real time, and a lot of questions have been coming up as Max's data showed for PitchBook. The markets have been a little volatile, and also we'll go ahead and post this link in the chat so you can participate, and you will also be able to access a subset of the results for no charge. So here's a preview. Are you intending to hire new staff in the coming year? And you can see from March 2022 to November of 2022 that number has gone down. No surprise, right? Things have slowed a little bit. And the next question, are you planning on freezing hiring due to a potential recession? And 87% saying no. And I think that's exactly right, that there may not be big uptick in terms of compensation because we had sort of these banner years, and Max's data showed that we had really, I don't know, Max, if you want to jump back in here, I don't mean to put you on the spot, but you really showed us that we had a huge uptick in 2021.
Yeah, that's exactly right. There's just a lot of money in the market chasing deals. And because of that, companies were, flush with cash to give people those raises or to hire on talent at just higher compensation there.
Yeah, and it was very much in line. I think this really speaks to the fact it's very holistic, right? Compensation, I get calls all the time and people refer to us to ask, can you help me with my compensation? I've got an offer. And we see this, and I'm sure, Jim, you get this as well, right? People to do their employment agreements and so on. And the reality is that short of telling you sort of what the speed limit is and what compensation could be for that role with a certain asset under management and the type of, and the job and the type of organization, it is not done in a vacuum like that. It really depends on the comp philosophy of the firm, of how everybody else is being paid, where they look at the value of your role. And so the data is very helpful, but it is just one component of the whole holistic piece of this. So it's very important that, and also understanding the market, what's happening with that, the total assets under management. So here's a look at the annual retention rate, and you can still see that the highest annual retention rate, and this was just new data, we pulled this data this past week, is 91 to 100%. And then the next group is 81 to 90%. So there's not a lot of turnover. And Jim, you can probably speak to this because listen, these firms and the LPs, they rely on the relationships, the portfolio companies, and also the type of the carried interest, which we'll get into, but this is not a quick, you don't come to these firms for a quick turnaround.
Yeah, and I think the difference between the venture firms and the startup companies that are, their revenue goes down, they raise less capital, they have to make layoffs. I mean, there was just a big layoff announced yesterday by one of the tech companies, is that, the capital commitments, once you have them, they're good for, the life of the fund. And so really your budget doesn't have to change. And it takes a while to get to liquidity in any of these companies. And so if you have vesting terms under your carry of typically 10 years, which is common over the life of the fund, you're incented to stay there. Your compensation is probably still going to remain in place. And frankly, it's the best job in the industry. And so it is something there's not a lot of turnover unless somebody within one fund decides to go and join another fund.
Okay, I'm sorry. I'm going to pull this up here because you talked about this. I've got a big deck here, so I'm going to jump around for a second, but that's a great point. It always comes up. So I'm going to, it's short of giving you whiplash, I turned the screen off for a second. So what is vesting time for carried interest? And we have our historical data because we've been asking this question for a very long time. We've been running these surveys for over 15 years. So we've gone from 2020 to 2021 to 2022, and you can see that that group of 10-year plus is now growing. So that's exactly what you were speaking to, Jim. So explain to us what happens for the vesting time of carried interest.
Yeah, so most carry-in funds, there's an acceleration period that's during the investment period. So if you think about in the life of the fund, where is most of the work done? The management fees are higher during the investment period typically, and the vesting is accelerated during the investment period. So if you have an investment period of X number of years, 60 to 80% of the investing typically happens in that time period. And then the remaining vesting happens over the life of the fund. And so you have a startup where you almost never vary from 4 years. In kind of the venture fund world, it's very typically like the whole 10 years. Now, sometimes some funds have a shorter period, as you see here from the survey. There's some that are at 5 years. You have some where there's a cliff vest of a year or two. You have some that accelerate at the end of the term of the fund. So there's a lot of variations to this, but as a general rule, you earn your carry over a longer period of time with a fund than you do with a startup company.
Yeah, because the startup for the vesting, just as an aside, it's a 4-year vesting with a 1-year cliff, right? You got to stay for a year to get the clock ticking. But this movement here from 4 years to 5 years to now 10 years is, and I know this from my venture colleagues, right, who, call and discuss this, and we're looking at the vesting times. It keeps getting longer. And the point, and also this dovetails exactly into what Max was saying, right? The time to liquidity is taking longer. And so, and it's not always an IPO, it's the M&A market is very active, and it takes a long time, especially if you're a life science company and you've got to go through, the whole regulatory process or anything that has clinical trials. And it is, so the return on these funds is very much impacting the compensation. So I'm on the carried interest. So this is, you can see here, this is just the chart from this year, and then this is the year over year. And then here's the question speaking to, we're going to move into this, Jim. I'll go back to some comp data as well, but maybe you want to talk through this slide about the vesting time equal each year, or does it change over time? And this is for partners and then other investment professionals and then non-investment professionals. It stayed pretty steady, but I know you touched on it, but if you would expound on it again, I know this is very important for people.
Yeah, and I think you look at it differently at what type of your role in is. If you're someone like me and you're a general counsel of a fund, your vesting period may be a straight line flat over a time period, 8 years, 10 years, what have you, because your role doesn't change in that fund during the investment period or not. If you're an investment professional, most of your work is during the investment period. You have to go out there and find good investments and then actively manage them right away. And then once they start to get to the kind of the harvest mode after the investment period, there, is supposed to be less work associated with it. So the vesting is higher during the investment period, as I talked about, and then declines after the investment period, but there still is an element there. What funds don't want is they don't want somebody like, okay, to make the investments and then leave, because somebody's still got to be there and manage these funds. And even though they're 10-year funds, no fund terminates at 10 years. They're 13, 14 years after extensions. And so somebody's still got to be there managing those investments and should get some credit. And if somebody were to leave after the investment period, they lose, their unvested interest at that time.
Right. And I think that also this goes to, which is why we're trying to link all this together. The attrition rates, right, are relatively low because people stay. You got to be present to win. And then if you're going to go someplace else, you got to start this all over again, right? So that's the part that gets to be very tricky, and why I can't tell you enough why it's so important when you come into a firm, or if you have an emerging fund, or if you're, moving into a new role, that you really understand the compensation. And right now there's so much more transparency. And I think that we've been integral in putting in infrastructure into what has been historically a very unruly business, right? Where it used to be more of a good old boy network. And now this has become a real career path. There's been a lot of lens on the diversity, equity, and inclusion. And now also further to that, in certain states, they're having a requirement for transparency in publishing ranges. And people are just more comfortable to ask and want to know. And I know that's why for us, the number of these jobs has really changed, and also the level of detail that we're asking around it. So I am going to go back to some more comp data, but while we're on the carried interest, Jim, will you explain this to us, sort of the 80-20 split and sort of the traditional way of the total amount of carried interest to the firm, the different types of, let's see what else we have here. I think this is the main thing to talk about, is the total amount of carried interest for the firm, so that when I go in and show the comp data for the percentages of what people have, how it relates to this.
Yeah, so there's I think it's best to talk about how, your percentage of the carry as an investment manager. Like how do you characterize that, and how it's it? So, you look at this data here, the most common vesting term or carry percentage is 20%. This chart shows that you have some premier funds off to the right that are 20 to 25%, 25% or more. The kind of the A group of funds are in that category. They may even have a ratchet carry where they hurt a certain multiple, they get a rate over that. So then you as an investment professional, you say, okay, there's this 20% pool or 25%. How much of that do I get? And that comes into, there's a couple of ways to do it. And Jody, can I go into those two now?
Yeah, I'm going to go right now back to the cash and carry. So I'm going to move there so that we can support this. And then I am also going to go into the salary increases because I know everybody wants that. And then I'm hoping that we are not out of time. So this is the cash and carry. And then here's the explanation of just the carried interest.
Yeah, and so let me talk about a couple of those. So really what you're most concerned about as an investment professional is what percentage of the carry you get. So if you put the carry, whatever the percentage is on a 100-point scale, what percentage of that goes to you? And that's ideally you have a percentage like that, so you know exactly of the total pool what you get. Very often, other than the most senior people, carry is calculated now on this carried interest dollars of work concept. And what that is, so everybody understands it, is it's kind of a term of art where if you have $100 million fund with a 20% carry pool, you assume that the fund doubles in size. So $20 million of carry on that fund if it doubles in size, 100 million of profits, 20%, $20 million. And then you characterize carry in a dollar number. So you give to somebody, $1 million of carried interest dollars at work. That means that if the fund doubles, that person makes $1 million over the term of the fund, assuming they vest in full. And that's what carried interest dollars at work. I think the more senior people would say they get 8 to 15% of the total carry pool, but very often everybody else has this carried interest dollars at work concept, and that's effectively how it means. Now, what that translates into a percentage, it's a little harder to figure out, but I also think it's also not bad for a person to think, look, if I'm here the whole time, I vest in full, the fund does a 2X, I make X. If the fund is a 3X, I make Y. That's very easy to understand.
Yeah, I mean, I think what the bottom line is here is there is not just one way, and the different levers. I'm going to go back even further right here to how we look at compensation and what we survey. And again, all this information is on our platform. The surveys are open all year round, and we are now updating the data typically every 2 months. If there's been a big, we have some pushes each year, and when we have those pushes, then we update monthly. So the data is very real time. And we ask the current base salary for each job, and then the current bonus, meaning if you got a bonus, what was it? An actual bonus. And then a target bonus is a projected amount. And then we come up with total cash. And total cash can be a combination of base salary and the actual bonus, the current bonus, or it can just be your base salary, depending if you got a bonus or not. And then, of course, the carried interest, we ask for the percentages and then the carry dollars at work and also an equity distribution if that is a lever. And then on the carried interest, we do ask all the questions around whether you contribute capital for your carry, how much that is. We very detailed. And as you can see, it can be confusing. Jim does an amazing job. I even learn every time that you talk. It's very tricky. So we're going to try and break it down here. So here is the cash and carried interest for a managing general partner of a venture capital firm with the 500 to 999, almost $1 billion of assets under management. And I will, just for our own stake here at Thelander, that we do have a legal notice that this is copyrighted. Should any of you happen to take a picture of this, that we do ask that you don't post it and that you don't distribute it, because we're glad you're here and we're glad to share it with you, but we just ask that you maintain the confidentiality and don't pass it on. So we can also customize these by the type of the job, the type of firm, the assets under management. This is all what our data set allows us to do on the platform. So you can see here the 25th median, 75th percentile, base pay, current bonus, so it was given, projected bonus, and then total cash. And total cash, again, the reason why the base pay plus the current bonus does not equal the total cash is because the sample sizes are different, meaning not everybody's total cash is a combination of base and bonus. Some people's are just a combination of their base pay only, right? So I hope that makes sense. I know I tend to talk fast, so I'm trying to slow it down here, but it's not a straight addition. And you can see that the total cash for somebody in this asset class goes up to $1.2 million for the 75th percentile. What we didn't show you here are the max numbers. And I think what we have seen over is in 2021, we saw the 75th numbers and the max numbers being used a lot for total compensation. So this does not include also, it shows the percentage of carried interest, but it does not show if there was a cash value of the carried interest that during the year. I did get a question that came in, if we could just clarify the projected bonus versus the current bonus. So the current bonus was actually paid. So whatever data we have here, the amalgamation of all of the comp information for this managing GP, their current bonus means it was an actual bonus that was paid. And the projected bonus is what is targeted for the next year. It's out on the horizon. So the total cash is a combination of base pay and current bonus for those people that had a current bonus, or it is just the base pay for people who did not have an actual bonus paid out. So hopefully that helped. And then the percentage of carried interest. So you can see here that the $1.2 million is the higher number, and that the median total cash is around $800,000. And then here is the senior managing director, so a different job, a little more junior, but a higher assets under management of $1 billion plus. So again, you can see the total cash, the median total cash is up $975,000. And the 75th percentile, $1.1 million, which is a little bit lower, right? It was $1.2 million here. So it's very much moves around depending on the job title, the assets under management, but most importantly, and I think, Jim, you can further highlight us, right? The more junior positions, that golden egg of the carried interest tends to be smaller if you're more junior. So the way that it's structured for the total cash has a different impact because of the assets under management, but the carried interest being larger is always the goal.
Yeah, absolutely. I mean, that's where you make most of your money, but it is interesting that, I don't know if you're going to show data, Jody, on smaller firms, but you'll see that base pay and current bonus, the cash numbers go way, way down. Yeah. That it's all based upon the carry, just because the management fees are not high enough here. The interesting thing about the prior slide I found is the question that a user, that a participant made of projected versus current. Given that management fees are not probably going to go down on these funds, there's really no reason for the bonuses to go down because the management fees are kind of like a fixed stream coming in. So it's interesting that the projected actually is lower across the board in this slide versus what was paid last year.
Yeah, I mean, we're running our salary increase and bonus survey right now, and we have really, I think, it's been it comes up all the time. We always had questions when we were consulting or people reaching out to us to say, how are bonuses given? And the days of just, the discretionary bonus because there was money left from the management fees, or maybe somebody left so they had more money, those days are really over. There is formality. So we'll see if we can touch on this. So the other slide I have here, so this is a senior associate job, which of course, this is a very highly populated role, right? Senior associate, because these jobs are very competitive, right? And this compensation tends to be very stable. And you can see it here, 2020, 2021, 2022. And so the total cash is the main thing to get to. And this is median. But you can see it's been on a steady trajectory up, right? And the percentage of carried interest has been a little bit on a steady trajectory down, that things were higher in 2020, and then it leveled off at 1%. And again, these are the median. So there are people who fall the 25th, there are people who go to the 75th, and even the max numbers. So this is the total cash is really the number I like to use as the guideline, because again, base salary may not be the whole answer because there may be a bonus that was given as well. And that is less sensitive to the percentiles, by the way, which we're not showing here, are typically maybe where there is more, the higher cash numbers could also go if it was a larger assets under management. But these jobs are competitive no matter what. And here is what you were looking at. This slide is great. Year over year, investment professional, median, total cash. So these are the different roles. So this is the total cash. Again, this does not take into account carried interest. And you can see this is for the smaller assets under management. So these numbers are definitely smaller. You can see the associate numbers. I know we're throwing a lot of data at you, but I also do, just because we're sensitive time, we're heading into 20 minutes here. I want to be able to answer questions. And I also want to make sure that we get to the salary increase and the bonus information. So this is investment professional, median, total cash. This is the next asset class. So you can see, I think the overall takeaway is that the higher the assets under management, just like Jim said, the higher the total cash tends to be, the base and the bonuses if they're given. Okay, so I'm going to stop sharing for a second and go back to our salary increase and here we go, salary increase and bonus information, because this is the sort of the preview of what is going on right now. Okay, perfect. Hopefully I'm making this look easy. All right, great. So here's salary increases. So did you receive a salary increase for the coming year? So this is a preview of the data that we already have. So you can see for the managing general partner, 43% from, so this makes sense to you. I'm going to try and say it so that it isn't confusing. The survey, we used to only run this survey in the beginning of the year. So the data was published in March. Because there's been so much going on with recession and people asking, and the market really, as you know, Max shared, there's been so much going on now that we opened the survey up because you all asked. And that's where it's nice to be a namesake firm, because I don't have to ask anybody. We can just do what we want. We can do what you want, actually, more importantly. So we started to run this survey in October, and we grabbed the data now to show you. And I think this is probably a very good indication of where we're headed, and that you can see that salary increases are going to be less right now. And here is the as a percentage of base pay for managing general partner. And this was March of 2022. And now this is November of 2022. So even the median number is staying a little bit lower. I'm having a couple of questions come in. So we asked, what's the personal structure for these funds? How many managing GPs are usually in the 500 million to the billion fund? And does the compensation have any relationship with the number of managing GPs? Jim, I'm going to let you answer that to give us your insights of whether you think, given the number of GPs or the managing GPs, is the compensation different for that sort of middle asset under management?
You know, the number, so we're talking about like a $500 million fund.
Yeah, 500 million to a billion. But I would say, you know, past the emerging fund into that sort of next level, but definitely not the $1 billion plus.
Yeah, so I would say just to target the 500 million, you know, 3 or 4 like senior people that are in that fund that are at kind of the top level. You saw the ranges though, where somebody was getting 40% at the 75th percentile on one of the slides. And clearly you can't have 4 people if somebody is getting 70%. So that would be either a smaller team or a smaller fund without people. But you know, 3, 4 is what I would expect in kind of that top category within that size fund. But they could have various titles within that. I mean, there could be like, you know, very often you have one person that controls everything, is the founder, makes the decisions, and they have a larger slice. And then there's 3 people that may have the same title nominally, but are clearly junior to that person.
Yeah, we see it all the time. I think it's a great question. I appreciate it because it also highlights there is not one way, right? And there are nuances of, even if many people have the same title, in terms of what their percentages are. And also some of this is very personal. It does, and we've had these conversations in our consulting projects. It depends on where people are in their lives. I mean, there is a human element that also impacts if people need more on the, you know, cash side today, and they are having less carry because they've got mortgages to pay or kids in college or other priorities. So there is, you know, the data is, as I said, is meant to be a guideline. And then within that, it gets flexed depending on the unique nature of each fund and firm. Here's a salary increase for the coming year for director/principal. I think overall, we're just seeing the salary, and also to answer your question, we're seeing salary increases going down. But in many cases, just like Max had shown on the PitchBook slides, the market was really hot. And if you were hired or you were being recruited by another fund or another firm or a portfolio company, it is very possible that your total compensation moved from being median to 75th or max. So it is very possible now that you are still at the high end. And that is why you are not receiving a salary increase. And also the percentages inside of the comp numbers that we showed are very much what people use as a guideline to flex in terms of how people are being compensated inside of a firm, right? So if you're in that 500 million asset under management fund, and you have a specific title, some people may be at the 75th percentile for cash and the 25th percentile for carry. Some people may be at the median for total cash and the median for carry. That's what those ranges of the 25th, 50th, 75th, and max allow you variability so that somebody could have the title, but not everybody is paid the same. So good luck with that one. You have to really disclose all of this. I think it shows you how important it is to really think about it, and that there is a comp philosophy, because sooner or later, if there is a very large disparity within certain titles, from my opinion, I don't know, Jim, if you see this, and my guess is it'll ultimately come back to haunt you.
Agreed.
Okay. Here's salary increases as a percentage of base salary, director/principal. This is always a very popular job. So again, you can see that the percentiles are going down, but this is also predicated on the fact that some of these people are probably being paid at the higher levels. And this is the year-over-year data for 2020, 21, and 2022. Did you receive a salary increase for the coming year? So you can see we're just a little bit of a touchdown for 20 as we're heading into this 2022 to 2023. And here is all positions as a percentage. I think this really just we're trying to show you here, obviously, the brawn of the Thelander data and the different ways that you can be looking at this. So again, you can see that things really went up. And this is the 2022. This is not based on the November 2022. This is from the March 2022. More information talking about each role. I'm just going to leave this up because I tend to go through this. Everyone tells me to slow down, that they want to take a minute to absorb it. And again, if you have any questions, we are monitoring that. So we're happy to answer those for you. But you can see this job, this senior managing director, senior partner, right? Things definitely went up. And this is where these people were probably getting a little, I don't know, in my opinion, from what we see in our consulting, this is where it gets tiring at that 10-year vesting, and you want to start to see a carried interest return. And so you want more total cash to help if you have to make a capital contribution. Also, you haven't really necessarily seen a carried interest return. So sometimes that's the explanation. You can see here for the managing director, some of these jobs in 2022 really took an uptick because, again, the markets were so hot. And we showed you here the salary increase as a percentage of base pay for the different positions, 50th and 75th percentiles. And this is from the March of 2022 data. This is not a preview of what we've seen, but you can just see that everything really has, these numbers in that 10% all the way up to 25%, very high. Okay, I'm going to move into the bonus information here. Also the key factors, this is part of it. The key factors corresponding with salary increases for investment professionals. This is part of what we touched on, that it is merit or performance-based, cost of living, and then employee recognition and retention. So, Jim, when you look at all of this, when you're putting employment agreements together, how much of this can be predetermined ahead of time? When people are saying that they want to be eligible for a salary increase or a bonus, how much of this do you design ahead of time?
I don't encourage anybody to lock anything in specifically. I think that most employees are at will. Most compensation increases are discretionary. Most bonuses may have an element of performance, but are discretionary. And I think that that's the market to do that, where, it's not saying, look, your salary is going to be X this year. It's going to be X plus 20% this year. I mean, I'm really surprised at those increases, because those are huge, double-digit increases. in compensation. And I'm sure it's just the market saying, look, I could go do something else and get a higher cash compensation or go to this other fund. But those
Right.
are abnormal. You just don't see those very often. But, most employment agreements we do are a base salary and maybe a percentage of bonus opportunity and a carry percentage. And then you evaluate it year to year, but
Right.
there's nothing like contractually you have to increase it.
Right. So here we've got the receive a bonus for the previous year, and you can see the 2022 was a very hot year. Also, these firms that were very streamlined and lean, they did not have a lot of, they have, one senior associate, and instead of hiring other people, they are going ahead and recruiting and making sure the compensation for the people they have is very competitive. But the sheer fact that these, I'm going to put in here the key factors, I think this is really important, is that the fact that these questions are here and there's all the information, around how are the bonuses given, merit or performance based, the firm-wide bonus pool, employee recognition. This is for all investment professionals. These questions of was the target bonus set in advance? And you can see that in 2020, the most 91%, right, was set in advance. And it stayed relatively at that higher number, though. It's certainly not dipping down to less than half. And this is for each job was the target bonus, was it set in advance? So you can see that these very competitive jobs, I think things were moving just so fast in 2021 and 2022 that bonuses almost became a guarantee. And it will be interesting to see how these numbers change this year. But the sheer fact that we're up into the 80s, the 90s, and up to 100% is very important on bonuses. I'm going to skip this part and ask what was used to set individual performance targets, because this sort of probably goes into, Jim, what you've seen. Is that it is sort of the MBO, the milestones. What kind of milestones can these firms have, in your opinion, Jim?
Yeah, milestones are variable by nature. I mean, it's tied to a particular individual and what you expect those out of them. I mean, there's a component of, overall performance of the firm. And I think that was like the bonus pool concept that you talked about. And I think that there's some
Right.
merit there, but you also want to drive performance. And so you want to drive from that particular individual. And what I found with like some of these bonuses is that, the fund looks at how that person's particularly deal did. And if that person has 3% of the total carry pool, but has a couple of knockout deals, they get this big cash bonus that year because the firm wants to take account of it. Now, you can understand with probably, like looking at Max's data, I mean, I'm shocked at, the exit profile, and well, I'm not, but it's stark when you look at it. Those bonuses are not going to be as big because they're just not going to be the big exits in 2022, and likely in 2023 either.
Yeah, I agree with that. So this is the question of, was there a change like in the way the bonuses were structured between 2020 and 2021? So we'll have this data for this looking back pretty soon, but bonuses increased overall almost 30%. So I have a feeling that we might see a little bit of a dip here and that they won't be increasing overall. But again, based on what we saw from this past year, they went up so much that it's impossible to sustain this. And this is the expected change in the way the bonus will be structured between 2021 and 2022. I'm going to move into, we have some other interesting data on here's the equity year program. I want to move to some of the diversity, equity, inclusion, just because I think it's obviously a very relevant point here in terms of the investment firm structure. This came up, and also the succession planning. So this is part, we can look at compensation this way, and I do think it is sort of relevant, is the 25 or less employees, right? The head count. And you can see that these 500 plus or so firms, obviously those are the larger asset class, are not as prevalent, and then the 26 to 50 employees. And this is a large sample size, right? This is almost 500 firms who answered this. And this is the firm headcount by total AUM. So I know, Jim, you're looking at this for the first time, but maybe you can clarify some of this for us. And I mean, you're not surprised, right?
Yeah, not at all. I mean, I think it makes sense in the target, and I was going to go back to like one of your your prior slides, regarding those the fixed bonuses in the prior year. I think what happened in 2021, because this happened in law firms too, is that the market was so hot, you were just looking for resources. And so there was all of
Right.
these, guaranteed, like, look, you stay here for a quarter, you get X amount, because that's how you keep people there. But all of that has gone away. I mean,
Yeah.
and, even where you're seeing like layoffs in the marketplace, because it's just not the same market anymore.
No, but the layoffs in the marketplace, and I'm sure that many of the people that are on the call right now who also are seeing their own portfolio companies, for example, I mean, because we deal very heavily with life science companies, and we're not seeing layoffs there because science and those technical people that are very sophisticated, but definitely some of the business development and marketing people and the tech companies have suffered, further in terms of needing to lay people off. But on the venture side, we have not heard of these top firms that are still have a lot of dry powder and are investing. They may not be hiring, or the headcount is being, the recruiting efforts have been tapped down a little bit, but they're certainly not letting go the people that are there. And Max said, you discussed this, Max, that, these larger firms have already raised their funds. And Jim, you said it, these firms you're not running through money real fast. I mean, the deals are not happening faster. If anything, the deals are a little slower.
Yeah, I think that's absolutely right. I think what happens is in boom markets, the performance reviews tend to be less diligent, and because no one wants to lose any people. I think when the market turns, as it has now, it's not that they're anyone's laying people off. The
Right.
committed capital is there. It's just that the
Right.
performance reviews are going to be more what they were prior to the pandemic boom. And I think there will be, but I don't think that, unlike the tech firms, I don't think the venture firms need to have widespread layoffs. They have this pool of cash, they can pay their salaries. Many times your best deals are in recessions, you find those. And so I actually think it's the time for venture firms to really go out there and hunt for that next big win.
I was just hearing that country song in my head, that dog will hunt. Yeah, it's time to hunt, right? And good people are always valuable, and the venture firms need the consistency. So here's the average firm structure by total AUM. This question comes up all the time. And again, we can correlate this to compensation. This is all on as I said, comes from the survey information, and we've extracted here just to give you a sense of how many different factors do fall into compensation, firm structure. So this is average firm structure by total AUM, and you can see the combination of partners, junior partners, other investment professionals, the entrepreneurs and residents, venture partners, operations, finance, admin. I mean, there's a lot at play here. And depending on that, really was a great question that came up earlier, sort of how does this factor into compensation? And it does, but it really needs to be looked at on a firm-to-firm basis. This is on hiring. If you hired individuals from outside the firm, 87% are saying yes. And of this, you can see that it went up big up in 2022. And where did they come from? So this sort of talks a little bit about the recruiting market, where sort of low-hanging fruit investment firms, private equity firms, other VC firms, graduate school, it's all over the gamut. And here's where did new hires come from? So you can see up investment banking is doing a really good job of training people, but it's obviously a very challenging lifestyle. And this is, does the firm have a succession plan? This actually is up. The 40% is up. Here we go. I knew it. Great. So from 2020 to 2021 to 2022, you can see that things are moving a little bit, having a succession plan. And this has definitely been a result of the diversity, equity, and inclusion. The top person is participating, and this is up a little bit. And then finally, the diversity, equity, inclusion. I just want to wind up with this, obviously a very important fact. We've had gender and ethnicity in our data for decades. So we look to see, I think the biggest issue is that there are just fewer women. Their compensation isn't terrible, but overall, we do see that a lot of women have left and gone to start their own funds, which, Max, you showed in the data. That part can be tricky, but this is policies and programs firms have in place to promote diversity in recruiting and career development. And then, talking about a pipeline. And then this is things that are, moving up, which is great to see because it's become more formal. And I know I'm going too fast, but I'm concerned that we're into 158. I guess my overall take here is that there are many factors at play. and that having the diversity, equity, inclusion, the committees, it all factors in. Now that things have slowed down, it's probably a better time than ever to take pause for this, because it is a very important component. And you can see that 73% of the firms that we surveyed don't have a DE&I committee. This shows it's still very prevalently a investment professional is still very much a white landscape, although there are some other factors and other ethnic groups that are rising here. And talking about the portfolio company, women and CEOs. So we cover it all. It's a very holistic component here about compensation, how the firms are structured, how the premium you put on all the different levers. And as Jim, I think so, your skill set and the amount of expertise you have, really it shows the invaluable resources for a firm if they're going to have to structure things or move in, raise different capital, that your expertise is very valuable. And of course, Max Wilson, the PitchBook component here, we wouldn't be here without PitchBook hosting and arranging and providing an amazing platform to the investment firm community and service providers. So we thank you all. Max, do you want to wind up with any parting words here?
Just thank you for your time again. Really appreciate you sharing the space and collaborating with us. And if there are any leftover questions, feel free to put them in the chat, and we can try to answer those either offline or just in additional material. So thank you.
And I will say again, if you would like to have access to a subset of these results, please reach out to your PitchBook account manager or email Morgan at J.Thelander, and we are happy to assist to give you access. And thank you all for joining us. We really appreciated having, the 100 and some odd of you here. We had a great group. And again, to PitchBook for hosting. And Jim, thank you.